Good morning and a warm welcome. Thank you for attending this morning's session on the future interest rate landscape as the financial sector transits from SOR to SORA. I'm Ong Ai Boon, Director of the Association of Banks in Singapore. Since the Steering Committee for SOR Transition to SORA, chaired by Mr. Samuel Tsien, ABS Chairman, was formed last year, ABS has been working closely with it together with the 7 technical subgroups. And so today we are pleased to have with us Ms. Jacqueline Loh, Deputy Managing Director of MAS, who will share with us the impetus and background of this important benchmark transition. And after that, Mr. Samuel Tsien, Chairman of ABS, Chairman of the Steering Committee and Group CEO of OCBC Bank, will take us through the progress and collective efforts made by the industry to ensure a smooth transition. He will also talk about the impact of the change on our customers and banks. A panel discussion will then follow, and I'll be introducing the panelists shortly. And now over to you. Ms. Jacqueline Loh, please.
Good morning to everyone. First, let me thank Ai Boon and her team in ABS for organizing this roundtable session and inviting me to speak. I think it's very heartening to see the large number of participants comprising banks as well as corporates, SMEs and retail customers joining this virtual session. I think this reflects the importance of the topic that we're discussing today, which is the shifts in the Singapore dollar interest rate benchmark landscape and what we must do in preparation. Interest rates in Singapore are determined by global developments given our exchange rate-based monetary policy framework. Against that, robust market-driven interest rate benchmarks play an important role in the domestic financial system and in the broader economy. So similar to other economies, interest rate benchmarks reflect the cost of borrowing in underlying markets. They're used widely by banks to price loans to individuals and businesses, by financial market participants in pricing financial products, such as bonds, floating rate notes, and interest rate swaps, and corporates as a discount rate for financial reporting of its assets. In Singapore, SIBOR and SOR have served as the key interest rate benchmarks in Singapore dollar financial markets for decades. They meet the needs of different user groups, with SOR used in pricing of bonds and loans to large institutions with hedging requirements, as SOR is also the reference benchmark in Singapore dollar derivatives, while SIBOR is mainly referenced in banking products for smaller corporates and retail customers. Changes underway in the Singapore dollar interest rate benchmark landscape will therefore impact all financial market participants in Singapore in your capacities as lenders, borrowers, savers, and investors. So central banks and regulatory authorities globally have been undertaking significant and sustained efforts on interest rate benchmark reform for a number of years now. At the global level, the Financial Stability Board, or FSB, has identified interest rate benchmark transition as a key priority. So derivatives market participants are encouraged to switch away from interbank offered rates, or IBORs, to near risk-free rates. So term unsecured interbank markets that used to underpin IBORs are no longer sufficiently active, as banks' funding strategies have fundamentally evolved since the global financial crisis. In response, several major jurisdictions have developed overnight interest rate benchmarks in their respective currency areas that are underpinned by deep and active underlying markets. So these include the SOFR, SONIA, Aster, Saron, and Toner. So transition progress and momentum have not slowed despite COVID-19 disruptions. So in the UK, while some interim transition milestones were delayed, the overall end 2021 timeline for LIBOR's discontinuation remains unchanged. Banks should be ready to offer SONIA loans by the third quarter of this year, and stop using sterling LIBOR in loan products by first quarter of 2021. While in the US, the Alternative Reference Rates Committee, or ARRC, recently recommended that firms should cease using US dollar LIBOR in firstly, new consumer loans maturing after end 2021 and to cease by September of this year. New floating rates by end of this year, and new business loans and derivatives contracts by June of 2021. Our industry here in Singapore has embarked on a similar reform journey to ensure that our Sing dollar interest rate benchmarks are credible, reliable, and transparent. In 2013, ABS and the Singapore Foreign Exchange Market Committee transitioned SOR from a poll-based to a transaction-based methodology. In 2017, ABS and the Singapore Foreign Exchange Market Committee consulted on a new waterfall methodology to make SIBOR more transaction-based, and transition testing was carried out from July of 2019 to validate this new methodology. And in August last year, ABS and SFEMC recommended a transition from SOR to the Singapore Overnight Rate Average, or SORA. And this is necessary as SOR relies on US dollar LIBOR in its computation and will not be sustainable when US dollar LIBOR ceases. In addition, SOR is a robust benchmark underpinned by actual transactions in a deep and liquid overnight unsecured Singapore dollar interbank funding market. And recently, given the expected benefits of achieving greater market efficiency in a single interest rate benchmark regime, as well as the good progress in developing SORA markets, the industry jointly recommended for Singapore's interest rate markets to adopt a SORA-centered approach. In short, a transition from SOR and SIBOR towards SORA. So what does this mean for Singapore dollar financial markets? Firstly, this shift is an opportunity for us to enhance the overall functionality and efficiency of Singapore dollar interest rate markets. For banks, compared to managing both SIBOR and SORA exposures, this approach will reduce basis risks between assets and liabilities based on two different benchmarks and allow for greater pricing efficiencies. For borrowers, the averaging effect from compounded SORA will provide more stable rates compared to single-day SOR readings, which is exposed to idiosyncratic market factors such as quarter or year-end volatility. And by concentrating activities in a single SORA-centered interest rate benchmark, market efficiency will be enhanced. Second, the adoption of a SORA-centered approach is aligned with the direction in key financial centers. So this will support the continued participation of global institutions and investors in our Sing dollar markets. And as our banks get ready for SORA adoption, this has synergies with their transition efforts to both trade and risk manage positions denominated in other major currencies, which are similarly shifting to risk-free interest rate benchmarks. So the recommendation to shift to a SORA-centered benchmark rate regime has been put out for public consultation. And if this proposal is well received, apart from seeing SOR being discontinued after end 2021, we would also see SIBOR cease after that. So this is a critical piece of work for MES and the industry. SIBOR and SOR have served as cornerstones in our financial markets for at least 2 decades, since the late 1990s. LIBOR, meanwhile, has been around for almost 4 decades, since the early 80s. And we are now at the juncture of having to replace all 3. It is thus of vital importance that we work together to ensure a smooth and successful transition. So MES fully supports the industry shift towards a new SORA-centered interest rate landscape. So we have taken significant measures to set a firm foundation for SORA and to encourage its adoption. Firstly, as the administrator of SORA, MES has issued a statement of compliance with the IOSCO principles for financial benchmarks for SORA. So this follows recent enhancements to the SORA methodology to broaden its market representation by capturing both brokered and bilateral interbank transactions. And compliance with the IOSCO principles demonstrates that SORA meets international best practice and will help it gain traction amongst global market participants. Second, to facilitate market adoption, MES also started publishing on a daily basis compounded SORA rates for 1 month, 3 month, and 6-month tenors, and a SORA index. So these provide market participants with a standardized and simplified way of obtaining compounded rates for any given tenor and can easily be referenced in new SORA products of different maturities to suit the needs of different customers. And third, to provide a market-based pricing reference for SORA cash products and to spur hedging activities through the SORA derivatives market. MES has broadened our suite of money market instruments by issuing floating rate notes based on SORA. And we are encouraged that the first 2 MES SORA FRN auctions were met with strong market demand. And fourth, to facilitate price discovery in a nascent SORA derivatives market, MES established in June a daily auction process for SORA overnight index swaps, or OIS as it's commonly known, and SOR to SORA basis swaps up to 5 years in tenor. These are the key instruments for developing the SORA derivatives market and for facilitating a transition from SOR derivatives. Going forward, MES will extend the auction tenors and make available this process to the wider interdealer market. But MES's efforts are not enough to achieve a successful transition from SOR to SORA. The financial industry and its stakeholders have a critical role to play, given that you are the ultimate end users. So to this end, MES established the industry-led steering committee on SOR Transition to SORA, or SC-STS, in August of last year, chaired by Mr Samuel Tsien, ABS chairman. The SC-STS provides strategic direction on developing new SORA-based products and markets and serves as a key coordinating platform to engage relevant stakeholders in support of a smooth transition. And since its formation, the SC-STS and its various subgroups have made significant progress in laying the foundation to support benchmark transition by establishing market conventions and infrastructure, building liquidity in the SORA derivatives market, conducting pilot test trades in SORA loans and bonds, and engaging market participants and end customers on the transition. And I would like to thank Sam and the subgroup leads for their strong enable leadership and the great work done thus far. Samuel will be sharing more on the SC-STS transition roadmap later, and will also chart out what needs to be done in the remaining 15 months to end 2021. So a key part of our work in the remaining months to end 2021 is the transitioning of legacy contracts from SOR to SORA. Close to 1.4 trillion notional value of outstanding Singapore dollar derivative contracts referencing SOR, and around 12,000 SOR contracts in Sing dollar cash markets amounting to 95 billion Singapore dollars will mature after end 2021 and will need to transition. So transitioning legacy contracts from SOR to SORA is a complex exercise. Execution needs to be well sequenced and tightly coordinated, and I would like to share 3 pillars that can support a smooth transition. Firstly, preparing early at the individual firm level. Secondly, coordinating well at the industry level. And thirdly, communicating early and effectively at the customer level. First, at the individual firm level, both banks and corporates must be ready to carry out this transition. So this includes identifying risk exposures, putting in place appropriate contractual fallbacks, ensuring system readiness, understanding the features of new SORA products, and ultimately transacting in these products. So indeed, we have some early wins, and MES is encouraged by the success of our 3 local banks in completing SORA commercial loans with early adopters such as Capital Land and Wilma. We are also heartened that OCBC had launched a retail mortgage loan, while DBS had launched a business property loan, both referencing the compounded SORA rates published by MES. And riding on these successful pilots, we hope to see more banks start originating new SORA loans across the broader industry. Against this, MES will be stepping up supervisory engagements to ensure that banks are well prepared for the transition. So MES had conveyed a supervisory expectation of banks through a regulatory survey conducted earlier in the year on the progress of banks' preparations for the transition. This engagement will continue and will include elements such as system readiness, legacy transition plans, and pace of adherence to industry guidance established by the SC-STS. MES's view is that early readiness is an essential ingredient in achieving a smooth transition. Early readiness on the part of the banking industry and markets will in turn encourage early readiness from their customers. A bank that adopts a wait-and-see attitude and leaves things till next year is likely to find itself with too much on its plate before the end 2021 timeline. And this is something we must avoid. Banks that do not keep pace with industry transition timelines potentially expose themselves to additional market, liquidity, operational, technology, and legal risk, and can expect to have more intensive supervisory engagement at the senior management level. Second, at the industry level, the focus must be on achieving a smooth and well-coordinated transition. The key challenge here is how to encourage market participants to shift from a SOR-based market, which is still deep and liquid, to the nascent but developing SORA-based market. We need to take deliberate steps to catalyze additional liquidity in SORA derivatives markets and engineer early and progressive shifts of activity from SOR to SORA to achieve greater transition momentum. And we will address this in 2 ways. Following the strong market response to MES's inaugural $500 million SORA FRN issuance, MES will expand this program through increasing the issuance sizes and lengthening the range of tenors. We will announce more details before the end of this year. And in addition, to inject greater impetus for market participants to shift from SOR to SORA, MES, together with the SC-STS, will outline guidance by October this year on specific deadlines to seize the usage of SOR in new financial products. It is important to provide forward guidance on this matter so that banks and end customers can move in a concerted way towards achieving a smooth transition. This ensures our financial system is well prepared ahead of end 2021. The forward guidance also matters from a risk management point of view. With the end 2021 deadline approaching, it is not prudent for banks and end customers to enter into new SOR contracts that mature beyond end 2021. Doing so only compounds the problem that banks and customers will eventually have to deal with. Third is the need to build a bridge of clear and effective communication between banks and end customers. MES expects banks to engage customers in a clear, timely, and transparent manner. This includes raising customer awareness and providing clear expectations on and clear explanations on, firstly, the global move towards using overnight near risk-free rates, the shift to SORA in the Singapore dollar interest rate market, how this benchmark transition will impact them, and how customer spreads over the loan reference rate may have to be adjusted to account for the economic differences between SOR and SORA, given that SORA is an overnight rate that lacks a term and credit risk premium. When engaging customers on benchmark transition, banks should take into account MES's fair dealing guidelines. This includes presenting customers with sufficient options, providing enough time and information for customers to evaluate available options, and helping them make informed decisions. Communications to customers should also be tailored according to the sophistication of customer segments. And to this end, banks should ensure that their staff are well trained to engage clients and to handle transition issues that may arise. And to complement banks' individual efforts at the industry level, MES, ABS, and SC-STS will work together with relevant industry associations and money sense to roll out industry-wide public education programs on SORA products and markets later in the year. And for end customers, you should work with your banks on a suitable pathway to reduce SOR exposures. We urge you to participate actively in various outreach events organized by the SC-STS and avail yourselves to the public resources that SC-STS will progressively be making available on transiting to SORA. So in conclusion, interest rate benchmark reform is an important priority, and Singapore is very much a part of this global undertaking. The journey is complex and challenging, but we have made good progress so far, thanks very much to the work of the SC-STS under Samuel's leadership. But we are at a critical juncture. And as market participants know, liquidity begets liquidity. And the sooner we take steps to front-load this change management process, the more likely we can create a virtuous cycle which facilitates a smooth transition to SORA. Conversely, if we delay the shift until it is too late, this will have implications of future market efficiency and financial stability at the industry level and higher risks at the individual firm level. So to this end, MES will continue to work closely with the industry to prepare ourselves early and to prepare ourselves well for the transition. If we get this right, we will reap the benefits of deeper, more transparent, and more efficient Singapore dollar interest rate markets in the new SORA-centered interest rate landscape. Thank you very much, and I look forward to a fruitful session today. Thank you.
Thank you, Jacqueline, for the comprehensive coverage. And now may I invite Mr. Samuel Tsien, please.
Well, thank you, Ivan, and thank you, Jacqueline. Good to see you all. I would like to extend a warm welcome to over 1,500 participants joining this webinar. We have joining us today our colleagues from the financial industry, our corporate, SME, and retail customers, our legal and accounting partners, and of course, our friends from the media. Jacqueline has just shared MES's perspectives on how we should plan and act to ensure that we will be successful in this benchmark transition. She has clearly laid out MES's expectations. As the chair of the steering committee for the transition of SOR to SORA, I would like to give you an update of the work we have done so far to prepare for Singapore's transition. Significant progress has been made. I'm optimistic that with the combined efforts of banks, other market participants, and customers, we will drive the transition in an orderly and transparent manner. I'm confident that we will see a successful transition come December 2021, when LIBOR will no longer be quoted. Since the start of the year, despite the unprecedented disruption brought on by the COVID-19 outbreak, the MAS, the steering committee, the 7 technical subgroups, and the banks have put in tremendous amount of time and effort to prepare and plan for the transition to SORA. They include from conceptualization and scoping of SORA applications to the creation of SORA products, from communication and education to documentation and transacting. And we have delivered major milestones for the transition. The steering committee was formed in August last year, as Jacqueline said, and since then, we have established market conventions for derivatives, established central clearing of the SORA derivatives by LCH, finalized the fallback rate for SOR, and determined its shelf life. And we've also stepped up communication within the industry and with partners and customers through numerous workshops, webinars, training sessions, and media engagement like this one. More importantly, banks have made good inroads in building SORA products and liquidity in both the derivative and the cash markets. We have been growing the trading volume in SORA derivatives, with the first SORA OIS trade transacted between OCBC and Standard Chartered in November of last year. We have issued SORA floating rate notes, with the first SORA floating rate note issued in May this year by DBS, followed by MAS's 6-month SORA-based floating rate note in August. We've also launched the first SORA customer loan. OCBC did the first SORA-based corporate loan with Capital Land in June, and also launched the first SORA-based home loan program for the consumer market in July this year. Last week, UOB issued the first dual tranche SORA-SOFRA loan, also with Capital Land, and DBS launched a SORA-packed business property loan package for SMEs. To our banks who have launched the various SORA products, thank you. Let us work together to do more. We encourage all banks to launch further SORA-based products to broaden the adoption of SORA by both the retail and the commercial segments. Even as much progress has been made, there remains much work to be done to complete the transition. Let me first touch on the market conventions and infrastructure support that are necessary for banks to deepen the penetration of SORA products. On the derivative side, we are looking into extending central clearing for SORA OIS and SORA SOR basis swaps from 5 years to 10 years, and the adoption of SORA for price alignment interest and discounting of derivatives. In the coming weeks, market conventions and contractual fallbacks across product classes will be finalized, and by the fourth quarter of this year, a SORA market compendium on market conventions and documentation protocols will be published to encourage standardization of practices amongst market participants as much as we can. The steering committee is also working on publishing a SORA usage guide for corporate and SME companies to enhance their understanding of use cases. In addition, we are developing an end-user checklist to guide our customers on practical considerations as they prepare for the transition and to assess your readiness. We're looking to publish these in early Q4 to help our customers get ready. To further help our corporate customers prepare for the transition, the steering committee has also engaged key consulting and accounting firms to help drive preparation and systems readiness among their corporate clients. And this will help ensure that both the financial and corporate sectors can move in tandem to achieve a smooth transition. We have recently announced the introduction of a fallback rate for SOR derivatives that mature after 2021. Now, that said, it is important to emphasize that there should not be extended use or unnecessary reliance on the SOR fallback rate as a new interest rate benchmark beyond its intended purpose, which is to solely act as a fallback rate for existing SOR contracts and nothing more. Fallback rate for SOR will be published by ABS for about 3 years from the end of 2021. It may actually end earlier depending on market development. After that, it will be discontinued. The reason for having a limited shelf life for the fallback rate is to avoid having to deal with a situation whereby both SORA and the fallback rate for SOR coexist for a long time. So the fallback rate for SOR is designed to only have a finite shelf life. And please allow me to remind all that banks and customers should avoid having a large book that is based on fallback rate post-2021. COVID-19 has created a new normal in the way we live, work, and play. The new interest rate regime without SOR by the end of 2021 and possibly without SIBOR by 2024, and with SORA becoming the only Singapore dollar benchmark interest rate, is likely and likewise will be the next normal. It changes the way pricing is quoted for our loans, investments, and derivative products, and the way we hedge in the Sing dollar financial market. Given that SORA is the next normal in the financial market, it is most important that SORA is clearly understood, not just by banks and the derivative market players, but it must be clearly understood and accepted by our commercial and retail customers. That is why the steering committee has been focusing on ensuring the engagement and communication by the industry and the banks with their customers are timely, adequate, and effective. It is one of the key pillars in our transition roadmap. SORA is fundamentally and economically different from IBOR or interbank offer rates such as LIBOR and SIBOR. It is a backward-looking rate. SORA is an overnight rate used in the interbank market on cash placements for 1 day only. It is a lending rate that is almost risk-free. It therefore carries almost nil credit risk premium and no term premium. In contrast, SIBOR and SOR are forward-looking term rates charged between banks for 1 month, 3 months, and 6 month placements and borrowings. SIBOR and SOR term rates have included both a term risk premium and a credit risk premium, reflecting the two risks embedded in the interbank transaction. Therefore, as can be seen from the data published since 2005, there has always been a spread between SOR or SIBOR, which is higher, and SORA, which is lower. To illustrate, in the last 3 years, the average difference between 3-month SOR and compounded SORA is about 37 basis points. Between 3-month SIBOR and compounded SORA, the average difference is about 48 basis points. What does this mean? It means that when SORA is used for customer loan pricing, the spread quoted over SORA would have to be higher than the original spread over SOR or SIBOR to take the additional risk premiums into account. The higher customer spread is to reflect the risk premiums associated with 1, the term risk, and 2, the credit risk, which are components not embedded in the SORA rates. It does not mean that the spread earnings by the banks have increased. After taking into account the 2 risk premiums, the final absolute amount of interest payments on the loans, whether they were referencing SIBOR or SORA, should work out to be about the same over the lifetime of the loan, everything else, such as market conditions, being the same. This is a very important difference that our customers need to understand. And the best way to understand how it works is to start exploring SORA products now and not wait to react when SOR and SIBOR are phased out. By exploring with SORA, customers will better understand how this new benchmark rate is used and how it is applied. By or before the end of next year, banks will no longer be able to offer SOR-based products because US dollar LIBOR used in the computation of SOR will no longer be available. As Jacqueline mentioned, the steering committee is planning to recommend an appropriate timeline to stop the usage of SOR in new loans and issuances before December 2021. We are studying this issue carefully and will issue market guidance on this in October so that all market participants have enough advance notice to prepare. The SORA-centered approach is aligned to the development that risk-free rates are being used across the global markets as new benchmark rates for financial markets. As more institutions start to use SORA-based pricing, the broadened use of SORA will facilitate the development of hedging instruments, price discovery, and other cash and derivative products. And this will in turn allow retail and corporate customers to benefit from a deeper and more efficient market with greater transparency. SORA is independently administered by MAS, as Jacqueline said. The rates are transparent as they are published daily on the MAS website. Since August, MAS has also started to publish 1 month, 3 months, and 6 month compounded SORA rates, which OCBC has adopted as a reference rate in our recent retail home loan offering. SORA is also more robust as it is derived from large daily cash placements made by the banks running into billions. As I said, all other major financial markets globally are moving toward a more transparent risk-free rate-centered approach. Singapore, as a leading financial center, is doing the same and needs to do the same. We have made good progress and gained good momentum over the past year. The steering committee will build on this foundation to continue with the transition plan. We urge all financial institutions, corporates, and retail customers to continue with their preparation. If you have not yet started, please get started. Remember, we are only 5 quarters away from the end of LIBOR and SOR. There is no extension for LIBOR, as has been repeatedly said by the FCA and the Bank of England. And as I have mentioned earlier, without LIBOR, SOR cannot be quoted. Finally, let me conclude on a lighter note. While it remains unclear when the COVID-19 vaccine will be available, it is definitely clear that SOR will end, the latest by the 31st December 2021. The good news is that SOR has a vaccine, which is SORA. We have been testing it with promising results and will expand its usage to bring it to maturity. The steering committee's hope is that all banks will be ready to dish out the SORA vaccine by early next year. If more and more of us adopt SORA sooner, the ending of LIBOR and SOR by end of 2021 shall be a non-event. Thank you for attending this webinar, and now I'll pass it on back to you.
Thank you, Sam, for your clarification and your explanation. And now please stay on the screen for the panel discussion. And now let me invite Mr. Piyush Gupta, Group CEO of ABS Bank, and Mr. Patrick Lee, CEO Standard Chartered Bank Singapore, as well as the moderator for the panel, Professor Annie Koh, the Vice President of Business Development and Practice Professor in Finance at SMU. Okay, over to you now, Prof.
Thank you, and good morning. We are actually a little about 6 minutes ahead, which I'm delighted. Congratulations, first of all, to Jacqueline. I think that speech is really important and it has given us the energy to power the discussion this morning. I love it, Samuel, that you set the hard date, all right, and that SOR and SIBOR will be no more, and we will definitely have to be SORA compliant and SORA positive. So there is a vaccine call here. Now, I'm also impressed. I have with me 3 fantastic bankers and banking leaders. And, you know, adoption to and making change, it's not something that can be done overnight. So I really like that one slide that Jacqueline shared with all of us. You have to be PCC, all right, the acronym. You have to be preparing at the individual firm level. And I believe all 3 examples that will be shared in a little while are exactly use cases that have been thought through, and they will be going deep with us on each of them. Preparing early is something that all 3 banking leaders have adopted. Coordinating well at the industry level. I think Samuel did it beautifully, telling everyone in the industry we couldn't do this on our own. We all have to come together. And I think the benchmarking, the risk-free, transparent, efficient benchmarking will make Singapore that deserving role of being a key financial center. So that is a mission, and we need everyone to come on board. It's almost like a call to champion a movement. And I really like the last C, communicating. I think change is always something that everyone is afraid of, but that transition can only happen effectively if we communicate well. So thank you, Mrs. Ong and the ABS team for actually putting this panel together. I see this panel as actually an example of how we share our learning. So we are learning and sharing together. And I think in that process, we would all get to learn. So without further ado, and in no particular order, but since SORA products, all right, have only been gradually introduced to the market, I'm going to go to the earliest derivative product. So Patrick, you kind of know I'm coming on to you now. All right. And I think the OIS product that was very early introduced in November last year. It get the market going, and it's to provide the necessary liquidity. I'm delighted it's between Standard Chartered Bank and OCBC, but I'm not going to get to Samuel yet. I really like you, Patrick, to kind of walk us through when you introduced this new derivative product. What was the process and the thinking behind it, and what did you need to put in place to make sure that it's a successful transaction? Patrick.
Thank you, Professor Annie, and good afternoon to everybody, and thanks everybody for joining today's session. It's so important to get ready for this transition. I think we were very excited to have participated in some of the early transactions in preparation, and as has been repeatedly said, early preparation is key. So we started with the first SORA OIS trade between OCBC and Standard Chartered Bank in November 2019. And it was the first in a series of transactions where we then traded other SORA products. In terms of preparation, I think there was a lot of hand-holding at the initial stage to get things up and running from a technology perspective, from a process perspective. We worked very closely with MES and with OCBC to get things up and running. So that, I think that early preparation did help us, and it was successful. There were no major issues. And I think with that, we were able to then sort of get on a stream of other products, which then led to the first cleared SORA IRS, as mentioned earlier, through the London Clearing House. So I think, so far it's been smooth sailing, no known issues. I think the key thing now for us as we think about adoption is how do we get more volume into the system? And I think there is an interplay with the cash markets as well. And as Jacqueline said, liquidity begets liquidity. And the derivatives are really are linked to, very much closely linked to the cash market. So if we can get more cash products out, and I know there are good plans, there's some good early transactions, I think that will also help deepen the derivatives market.
Very good. I like the word hand-holding, Patrick. So how much hand-holding took place, and what were the key people that you would kind of get together to bring that buy-in into the product that goes out into the interbank market?
No, I think we were, obviously this was led by our Treasury Markets team, and our global head, Dan Koh, he's also on the steering committee, was very closely involved. So I think there was very close coordination with him and his counterparts at the other banks and with MES in terms of setting it up. So I think that hand-holding was there from months before we even started the first transaction. So very early preparation, very early adoption was key.
How many months were needed? All right, so I know it's the first transaction, and once it gets going, it becomes easier. But how many months were needed for that prep?
Well, I think we started the discussion already early 2019, so it was already a journey from that. And as we got closer to the first transaction, as you saw, ABS already made some announcements about the way forward in mid-2019. I'd say it's a 2 to 3 year journey for us.
Very good. Thank you very much, Patrick. We'll come back to you in a little while. I'd like to move the radar onto Samuel. All right. And Samuel, you kind of mentioned it earlier. I think, interbank, you have the same nomenclature. You are very comfortable with each other, with the terminology. It was amazing that you actually had a SORA-packed retail loan and then going to the level of that corporate loan with CapitaLand. So maybe you could give us some visibility and sharing. Let's start with the CapitaLand loan first, because at least that is a big counterparty and hopefully a customer that is sophisticated enough to understand, all right, what it means to use SORA benchmarking. Sam?
Thank you very much, Annie. I'll talk about both of the segments, corporate and the retail, as you mentioned. First of all, the transaction with the CapitaLand, we take quite a number of months to understand each other as to what it means. What does the reference rate mean? And then once you understand what the reference rate is all about, you really have to understand how it is applied. Because the application is that it is on a backward-looking rate basis. So it means that you will not be able to know the rate until the next interest rate payment date.
Right.
Because it is also backward-looking, then when do you determine the interest rate? So I'll talk a little bit about the details of this transaction. And CapitaLand and ourselves has issued a public statement on this, being the first corporate loan transaction. So there's no customer sensitivity information here, except for the spread. I will not talk about the exact spread.
Yes.
The loan is a $300 million loan for 3 years. It is actually sustainability linked. Within the $300 million loan, there are two portions to it. $150 million is based on SORA for 3 years, and the other $150 million is just a revolving line, which is therefore short term. So the $150 million of the $300 million, which is using the SORA backward-looking rate as the reference rate for the interest spread. We did look at what is the equivalent amount of interest rate that would be charged to CapitaLand based on SOR, which is the existing rate. However, between SOR and SORA, I've just mentioned in my remarks that the risk premium and the term premium is not there. So we need to adjust the spread to make sure that it reflects the absence of those two risk premiums in the SORA rate. So what we did is that we look at what would be the spread that is reasonable for a client such as CapitaLand. And we look at the basis swap rate between the SOR and SORA, because that reflects the risk premium, that reflects the tenor and the credit risk, and then we add on to it. But this does not mean that the client is paying more. It just means that the SORA rate being lower than the SOR rate, it's adjusted back to reflect the two rates. Along the line, there are other details that we have to work out. For example, what is the backward shift observation? What do you mean by that? Because we cannot tell the client that this is the interest rate due for the rollover period of 3 months, and now you have to pay it today. The customer has to prepare for it. So we built in a 5 business day backward shifted observation period, which means that the interest rate that was determined for the previous rollover period was determined 5 days before the interest payment date. This will give the certainty as to what that interest rate is that you need to pay upon the maturity of the loan. And along with that, I think both the client and even ourselves learn, because it's the first loan in the market, and we have to learn what does it mean, how do we create system readiness, what is the process to verify the rate. So this is the corporate side.
So wait, Sam, so amazing. So this is the part, communicating with the customer, all right? And what was that clinching point that made CapitaLand say, okay, I will do a SORA loan and, not insist on the previous terms? What was the turning factor?
Well, CapitaLand is a very forward-looking company, and their treasury team, led by the CFO, Andrew, is also a very forward-looking person and the team. So they know that the SOR rate is going to go away. And if they were to do it 3 years, 3 years from now, SOR will no longer be able to be quoted. So either they go into the SOR fallback rate, or they just take the fate and go into SORA rate, because they have to live with the SOR rate anyway.
Yeah.
They accepted it, that this is the way to go. They spend time to understand how it works. They look at all of the historical rates and compare it with what it would have been if it had been based on SOR. And then we work with them. And as I said, we also learn with them. They are a very advanced team, very knowledgeable. We also learn with them and we cope with them in that respect. They also have to prepare systems preparation, because they also want to know how much are they being charged, and to not just rely on the bank's reference rate that was given to them. So preparation work on their side as well.
Okay, so how long did this whole structuring take? From communicating the preparation, the operations and systems, all right, to kick it and get it going?
I think the discussion started 5 months earlier than before we concluded the transaction.
See, the timing gets shorter because you learn from whatever you have been hearing from the market, and then you have very sophisticated customer. So how do you manage to also do this SORA benchmarking for your retail clients in terms of the retail loans?
For the retail clients, one of the major issues that we need to overcome is that the retail customers do not want to have a backward-looking rate. They want to have a forward-looking rate. In other words, how much interest rate are they going to pay on day one when they book the loan and upon the rollover date?
Yep.
So the whole purpose is to let them understand how the SORA work, what is SORA, and where can we get the comfort that the SORA rate is indeed a good reference rate from the market perspective. So we actually accommodated the customer's mindset, which is not yet ready for a backward-looking rate, and build it into a forward-looking rate by looking at the historical SORA rates. For the rollover, our retail loan is a 90-day SORA-based rate. And so every 90 days, we do a reset.
Yep.
We do the first retail program based on SORA. It is actually a simple average SORA for the past 90 days that will become the rate applicable to the day of the rollover. And at that time, MAS has not yet published the compounded rate. Now, immediately after MAS published the compounded rate, we drop the simple average program, we move on to the compounded average program. But it is still forward-looking instead of backward-looking. So it takes some basis risk on our books.
Yeah.
The past 90 days is not representative of the future 90 days on a backward-looking basis. But because of clients' preference and the client's understanding is not yet at the maturity level that our corporate customers have, accommodated that by putting in the compounded forward-looking rate. And we did this program, and it's quite well accepted by it, because we also look at the rate that we're going to charge based on the forward-looking rate, and then ask them to compare with the market-going rate. It's about the same. But the purpose is to get them understand that there is a term called SORA, how it works, and this is where the transparency is, and they've accepted that. So education, communication, but also accommodating their gradual maturity is very important.
Yeah.
Our approach.
So again, timeline. So this is another group of bankers. It's not your corporate banking team and treasury people talking to capital and treasury. This is your loans team and talking to your retail client. How long did it take to launch this product?
For this particular retail product, I think the internal communication, internal crafting, simple average to compounded average, having the scripts ready to explain the forward-looking rate, and where can you get those rates? Those are more, we will prepare more internally than externally. Because ultimately, when we introduce to the external market, the customer look at what is the rate that you're going to charge me. They look at that. And we fix the rate for 2 years in our retail program. After that, it's going to open up again. So we fix the rate for 2, meaning fix the rate based on SORA for 2 years. So there's a spread over SORA, and that spread is going to be maintained over a 2-year period.
Right.
And after that, it's going to open back up. So the customer has an easier task.
Yes.
They look at what is the absolute rate that they're going to pay now. They compare with the historical rate, and they feel it's reasonable. They just go ahead. But let's emphasize that the retail loan is not yet on the backward-looking basis, which is the real SORA. This is a SORA which is referenced on SORA, but it is still forward-looking.
Yeah.
As time goes by, we will adjust it back to a backward-looking SORA rate.
Very nice. But I love the conversation, and I'm coming to Piyush in a while, that actually a lot of internal communication are actually critical. And yes, and while you take away the pain from the customer, you are actually having to develop within the basis spread between the backward-looking and the forward-looking SORA benchmarking. So you see, that's what banks do. Banks don't want you to, get too complicated, and they want to communicate it such that you give it the right rate that you are preferring. for you, Piyush, all right? I am so delighted that you have actually been looking at the SME market. And I think this was fairly new. You have actually have a SORA-based property loan, all right? And we started recently for SMEs. But can we take you to that corporate level first? Wilma, tell us about the Wilma loan, because again, it's a corporate that knows the market, but it's not a capital land, it's an agribusiness, and there's sufficient volatility in the business. And here they are doing that first agribusiness SORA loan with you. Tell us, how did this whole process go?
Actually, thank you. The Wilma loan is very similar to the capital land loan. And I think at a corporate level, if you have a sophisticated treasury who understands pricing, it's much easier for them to get their mind around, how SORA would work. For us, some of the issues were the same as Sam described, which is, get practice within the company as well as within a client. How do you think about SORA? What is the adjustment mechanism? What is the actual dates at which you start setting these rates, et cetera, et cetera. So one thing we did incrementally was to provide an interest rate swap. I think the option of an interest rate swap. And the idea there was only that if the client wants to try and convert a backward-looking date to effectively a fixed rate over 1, 3, or 6 months, we'll try and give them that option. So we were able to, the way we structured the facility, it's a $200 million 3-year facility, revolving credit. We've got 2 tranches. Half of it, 100 million, can be taken in SORA. The other 100 million can be taken in SORA. By the way, this one of your earlier questions, Annie, how do you incentivize the client? This way, the client at any point in time in the choice, if they think that SOR is still more advantageous to them, they can do it. We're not sort of forcing them to go down the SORA path. But my hope is when they look at it, they realize that the SOR and SORA, they're really very little to choose from. And therefore, it gives them the confidence that you can actually start using SORA as well. We use the rate, which is the same compounded daily SORA with an adjustment spread and a margin. But the way you work it is you work backwards and say, what is the effective pricing Wilma would pay in the market? And your adjusted rate reflects that kind of pricing. So very similar to the things that Sam talked about. But what we added at the start of each interest period, Wilma can do a SORA interest rate swap with DBS. So we can take the backward-looking rate and give them a choice to fix 1, 3, or 6 months forward. Now, the problem with that, even though we did that, we, unlike what Sam said, our SME is like Sam's OCBC retail. But in the corporate, we're actually hedging in the market. We're taking a backward-looking SORA and getting a market price. And as Patrick said, over time, liquidity will come. You'll get better rates in the market. Today, the market is still thin. And so one of the problems in doing this, offering an interest rate swap based on the market, is the bid-offer rate on that swap is still relatively high. So the bid-offer rate on this is close to 8-10 basis points. If you did a normal swap, you would be getting 2-3 basis points. So the market liquidity needs to develop if you really want to build this as a basis of being able to convert a backward-looking rate to a forward-looking rate. I think it will happen eventually. And some customers who will not be comfortable with backward-looking will take recourse to the swap market to try and fix it for various tenors, but we still need greater liquidity in that space.
Right.
On the SME loan, we did exactly what OCBC did. We did not actually try to hedge the backward-forward basis in the market. We just took it on our books. And by taking it on our books, we are taking the same basis risk because the 90-day backward and the 90-day forward, there might be a gap. We've looked at it by and large as an absorbable risk in the short term. And we're doing it just to give confidence to the SME customers that they can get a forward-looking rate and build some confidence in the market. But again, over time, if the basis risk is material, then we would have to start trying to swap and actually hedge ourselves as opposed to holding the basis risk, which is what we're doing at this point in time. The difference, obviously, in the SMEs, unlike the large corporates, where the transition is mostly SOR to SORA, and you can give them 2 choices, a SOR and a SORA in comparisons. In the SME world, a lot of the transitions from SIBOR to SORA. So a lot of the rates are SIBOR pegged and property loan rates are SIBOR pegged. And so they've got to look at a different basis of comparison when they do that. But again, we've tried to do the same thing, that the all-in end rate to the customer is consistent with what they would pay under their old cyber packages. And I think Jacqueline's earlier comment, the question of fair dealing, I think that's what we need to do. We've got to make sure customers are educated, that the underlying reference rate is different. It does not have a risk premium or a term premium. So the credit spread will have to capture the difference, but the all-in rate will be comparable to what all-in rate you used to get, so you're not being disadvantaged. We've tried to communicate that as well as we could. Like I said, for the large corporate, it's easier. For smaller SMEs, you've got to make sure you're transparent in your communication and get it out there. But that is the intent.
And I love this. All right, all three of you have given us great hope that this transition would be, done fairly easy. But those are for new products, for products which you have just launched and customers who kind of recognize that if you don't go SORA now, the pains will be worse. Jacqueline provided an earlier set of numbers, which I was very intrigued. 1.4 trillion notional in the derivatives market that need to be transited from SOR SIBOR to SORA. And there are about 12,000 SORA contracts coming up to 95 billion. So gentlemen, any one of you can jump in here to help me out. What do we do about legacy? Legacy contracts, legacy loans, which are pegged to a different benchmark. How do we get this going in the next 5 quarters? The hard date is December 21. Any one of you? We are all learning from everyone. Yes.
Annie, maybe I will make some comments, and Piyush and Patrick can supplement my comments. Now, with respect to the derivative market, which beyond 2021 December, we expect there will be 1.4 trillion outstanding. We're going to work a protocol into the ISDA arrangement such that there will be a protocol already established as how to transit. And in a way, it is easier for the institutional derivative market to work on it, because once you have the protocol, and the protocol needs to be agreed to by the parties, but there is a standard type of protocol worked out with the ISDA, and it will be a rather smooth transition as we see it. The difficulty is more on the non-derivative market, which is the loans market, which the 12,000 contracts is quite big, and 95 billion is also quite big. That is what we call the legacy contracts. Although we have worked out a fallback rate for SOR, but remember the fallback rate for SOR, of which the calculation and it is also backward-looking, is quite different from SOR. So fallback SOR, although we use fallback SOR, it's actually very different from SOR in terms of calculation, in terms of its methodology. So we really need to ask all the market participants, and including the corporate clients, retail clients, as well as SME clients who are on SOR, to work with the banks to make sure that we're able to transit it as quickly as possible. I don't think everybody will be able to transit out by December 2021. Some will go into the fallback SOR, but fallback SOR is not a permanent benchmark. It can also be exited. So you need to work out. So the legacy needs to be worked on. The communication, the engagement, and the education is the most important thing.
Okay. Piyush, you want to jump in? Piyush, yeah.
Sorry?
You were muted earlier. Now you're good. Yeah.
Well, I'd say I have nothing more to add. Sam said it well. The derivatives market is easier because of ISDA. The cash market, you have to repaper and you have to renegotiate, and you have to do that customer by customer. I think the key to this is large-scale education of customers. Frankly, this webinar is a great case in point. We did one a month ago for our large corporate customer base as well. Again, we had some 300-400 customers, some 600-700 attendees. We just have to make sure that our clients, both retail and corporate, begin to understand the imperative need to switch to the new pricing mechanisms. And if we do that, then you'll get smoother. If you don't, then you'll have the residual rump, which you'll have to do fallback rates and so on, and those won't last forever either. So there's a big education exercise. We're actively getting our relationship managers to reach out to customers in the corporate space. We're going to start that in the retail space only towards the end of the year and early next year.
So for Patrick, what about counterparties that are outside of the country? You know, we are all very like-minded here on this panel, and everybody's like benchmarking SORA is the way to go. What happens to your legacy contracts with counterparties which are outside? I know Standard Chartered do quite a bit of offshore as well as the other banks. Yeah.
No, I think the good thing is that this is a global move as well. So it's not just Singapore, but we have the whole IBOR transition that's happening. In fact, the problem we have is that I think clients are a little bit tired of all of this. In fact, there's been years and years of repapering because of regulation and changes and margin changes, and now the IBOR transition. So I think people are aware, and we can leverage off the global programs that are happening, especially for our counterparties that are outside of Singapore, who tend to be the financial institutions, the global players who have that knowledge and awareness. And I absolutely agree with Sam and Piyush. The early engagement, education is really important across all the markets, and having a consistent message that it's out there. Unfortunately, the reality of this is this sort of thing is it's a bit of a hard grind. You just have to keep at it, keep talking to the customers, track your conversion rates, and make sure that you don't have a sudden sort of a big tail at the end.
Very good. No, I am just being a little bit cheeky here, but I'm allowed to since I don't have, I'm a moderator. So if you were to have a wish list for the MAS, what would you be requesting for? Jacqueline is online, yes. Anybody? I must tell you, I'm very, very impressed with the support that's coming from MAS. So, but on top of all that, I'm sure you're not asking for the date to be, deferred.
I think maybe I'll start first, and Patrick and Piyush can add into that. First of all, we have to acknowledge that MAS has done a lot of leadership role in leading the market towards its direction, and they've given endorsement to the approach that we have adopted, and to put their strength behind it to make sure that the customers understand that this is the direction of the market is going, so that it's there. There is one point at which we are still working out to see, is there any way that we can communicate a common message? And that is the point that I mentioned in my remarks.
Yeah.
When people look at SORA, they have to understand the base rate of SORA did not have the two risk premiums that I mentioned, the term premium and the credit risk premium in there. It is not easy for the customers to accept that you use this as a reference rate, but the spread is different from the previous spread that you charged me based on SOR or SIBOR. Is it? And are you taking advantage of it? Can we build in a fixed component so that we can explain this is the risk premium and this is the tenor premium? The answer to that is it is difficult because what was charged before as a spread over SIBOR or SOR depends on the risk premium depends on the market development. If the market is basically in a more risky environment, that risk premium, which is not the negotiated spread between the customer and the bank, it is actually the risk premium embedded in the two different rates. That risk differential can actually be different. So whereas everything being equal, the customer should be paying exact amount of absolute interest rate.
Yeah.
But market situation cannot be exactly the same.
Right.
We do not want the customers to feel that we're taking advantage of this transition and charge more, which is never our intention. We do not want to take advantage of those at all. It's just market-driven reference rate being different. So to that end, I think the steering committee is also discussing with MAS to see what type of communication can we give to the market to give the market the confidence. It is not something we want to take advantage of. It's just the base differential is there. Yeah. So that's an area that we can work further, I think.
Thank you. Sam, anything to add from Piyush and Pat?
Well, only this. I was going to go exactly there. In some jurisdictions, the regulators have taken one step more and tried to come to a standardized adjustment. I think the US Fed has tried to come, or some of the regulators tried to come up with a standardized adjustment process instead of leaving it to each bank. And that is something that we still have to debate and consider if that's practical and worth exploring.
Okay. And Pat?
No, I think just on the education piece, the obviously the endorsement of the regulator and the government that this is why are we doing this? Why it's good for the market, for customers, because otherwise I think it is a little bit confusing. So we need to sort of distill it down, make it sure it's a very clear message, so that the man on the street can say, okay, I understand why we're moving this direction and why it would benefit me.
Very good. So we have the communication piece looking like it's very core, and I like that very much. And of course, at the industry level, the representation from the industry, and of course, the endorsement from the authorities. Now I'm going to go to your individual bank level. At the level of your own people, at the end of the day, you can't have great products if you don't have great processes and people that understood why they have to do this. Is there a lot of retraining needed? Are you looking at in that direction, the people piece? Piyush, I see you nodding your head. Can you share what you're doing at the people level?
Well, actually, internally, and it's not just the people, we're having to work at 3 or 4 different levels. One is technology. So our systems are not adequately equipped to handle some of the stuff. Today when you put in a loan, you put in a rate and the system accrues the loan at a particular rate. Now you got to redo the system to be able to capture the daily rate, compound it, and then apply it to the loan product. So you got to switch the technology, and that's a meaningful change. You also have to make changes to your pricing, to your models. So, for bonds, derivatives, and for the derivative market, you have to come up with new valuation models and new risk management techniques to be able to handle that. So that's a separate kind of change which you got to work at and get people engaged. But to your point, one of the biggest challenges is on the people side. And that's at different levels. One, we've got to train all of our customer-facing people.
Yeah.
Both the bankers as well as in the retail space, the product people, etc. They've got to be able to understand the logic, and they've got to be able to communicate simply and succinctly to customers. So you've got to train them. We're actually using a lot of both internal and external trainers to train up people to be able to handle that. You've got to create a lot of internal repositories of knowledge, right, for the whole transition, how it works, and simple stuff with FAQs, infographics, stuff that customers can access directly, but our internal staff can access as well. We're actually conducting a lot of focus groups with customers, doing group contracts, and then like these things, we're doing a lot of customer pilots to handhold customers down the process. For all of this, we will train our staff. And then we've got to train the operations staff as well, so they know how to deal with this from a back office standpoint.
Yeah.
So there is a substantial amount of skilling and education work involved.
So 5 quarters, enough time to do all that?
Well, we've been doing it for some time. So it's not just forward-looking. We have been on this journey now for the last year or 2, and we made a lot of effort already.
Okay, thank you. Pat, Sam?
Sure. Just to add everything that I think Piyush is doing, we're also following that. We've also incorporated a lot of the into our regular ongoing training programs, the skills training programs for our people, and just recently increased our investment there. And we've also got our people, our experts in the financial markets and treasury side to conduct training sessions as well. But this is a multi-year initiative, as mentioned.
Right. And Sam?
Nothing more to add. I think on an industry level, we have a steering committee within the OCBC Bank. We also have a steering committee, and the steering committee goes beyond SOR and SORA because it has to be IBOR. All of the IBOR rates are going to be replaced. And we look at not only in educating the customers in the communication, we also look at finance, accounting, technology, new product development. All of these areas will be impacted. So it's very, very penetrating in terms of the effects of this change to the business operation of the bank. And we have to look at it very holistically.
Very good. And I like the comment that Piyush made that even at the board level, speaking to the board about it. Jacqueline, do you want to have a last word to all this conversation that has taken place?
Prof, no, I think I'm really very encouraged to hear from the different bank CEOs, and I think the progress is encouraging. There are a few areas that have been highlighted within the banks needs to be worked on. And as an industry, there are a few issues that I think we, should take back and continue to discuss and consider. But I think this is very good progress by the industry and would reiterate the points that I'd highlighted earlier on the PCC. Thanks, Prof.
Thank you very much, Jacqueline. I'm going to hand over the mic to Iboon. I'm totally encouraged. I think these are exciting times, and then we can all learn, all right, and relearn and do the learning in an articulative way together. So back to you, Iboon. Thank you very much.
Thank you, panelists and Prof. Thank you very much. And so, ladies and gentlemen, we have come to the end of today's session, and we hope it's been useful and it's been fruitful and it's been a purposeful time. Now, today's session has been recorded. It will be uploaded on the ABS website, and the website URL is shown on the screen. And if you have more questions relating to this subject matter, please send them to sortransition@abs.org.sg. So it leaves me now to thank Ms. Jacqueline Loh, Mr. Samuel Tsien, Mr. Piyush Gupta, Mr. Patrick Lee, and last but not least, Professor Annie Koh. We appreciate all of you for taking time to speak to us this morning. I also thank every one of you for your kind attendance and attention, and have a good afternoon. God bless all of you. Bye.